Good morning, everybody. This is Signet with the Bullish Bears. I'm going to be streaming in the swing trade chat room today. I want to focus quite a bit today on implied volatility, a lot of options talk today. I know that we've gotten away from that quite a bit. You know, the new micro futures came out. We really stepped back from the options, but when it comes to swing trading, the options really is our gameplay. And with the in and out of the different people coming into the community, I think that there's been a gap between the last group that we really taught and the new group coming in. If you're newer to the community, welcome to the community. You might not know me very well. I was brought in to teach and develop advanced level options strategies and educational content. That might sound a bit vague or uh, a mouthful, but it basically comes down to the idea of trying to teach you how to use options in your trading consistently and profitably using volatility, time, and portfolio tactics rather than trying to trade based on price direction. The reason we don't want to focus on price direction is that we suck at it. Everybody sucks at it. The biggest names in the business suck at picking direction. So, you can get your occasional trades where you're hitting at 55, 60, 65% picking direction, but more often than not, you're as good as a coin flip. And it's not just you, it's not just me, it's the biggest names in the business. The difference between the institutional traders and the retail traders is that a retail trader will cut their loss and walk away. They'll close a losing trade. And the institutional traders won't do that. They'll hedge that trade and they'll let the probabilities work itself out. More often than not, if you give the trade enough time, eventually you'll be right. You just got to sustain the trade. The institutional traders can afford to do that. We can't. As retail traders, we cut our losses and move on. So they're not picking direction any better than you are. To increase your win rate and to increase your probabilities of profit and your success, you need to start taking trades that play the numbers. This is the key to options trading success, and most people don't do it. Maybe it's because of the size of their account. Maybe it's because they don't know how to do it. Either way, we can teach you how to do it, and then as you grow your account, you'll be able to institute and apply these tactics and strategies to your trading. With it being earnings season and everybody wanting to play that, I wanted to focus a little bit on trades that we could do for earnings. And it's not just for earnings. They'll work just as well in any other trading environment, but when it comes to trading earnings, picking direction is worthless. It doesn't matter what the candles look like on the chart. There is absolutely no way to tell what a company is going to do when it reports. They could have the best numbers and drop the ball when it comes to presenting the data, and the market will crash. They could have some really bad numbers, and when it comes to presenting the data, they could do it in such a positive light that everybody jumps on and it runs to the moon. Right? So there is absolutely nothing that we can get out of the candles to anticipate what a market is going to do at earnings. But the one thing that we do know is there's going to be vol crush. And it's not very often in the marketplace where we say we know what's going to happen. There are, of course, some occasional situations where a product has earnings and its volatility actually goes up. But that is such a rare occurrence that more often than not, it's an IPO product that has that happen. Beyond Meat was a really great example. They actually had earnings and their volatility went up. They didn't get vol crushed. A very interesting situation. Is very, very rare. So if you give me just a moment, I need to fire up the Swing Trade chat room live stream. We're having audio bridge issues. Good morning, everybody in the swing trade room. Good morning, good morning. I need a sound check, please. Thank you, Gabe. Thank you, Rob. TJ, good morning, everybody. So it is November 7, 2019. If you are new to the community, welcome. My name is Signet. I was brought into this community late last year to develop advanced level options education and trading strategies. I have recorded a lot of educational content that you can find on the Bullish Bears webpage. If you go into the advanced level training library, you'll find this content, and it's not the vague stuff that you might find if you go to YouTube, if you search for a debit spread strategy, right? It's going to be a more specific video that will point you to what deltas to use, how to calculate your probabilities of profit, how to determine what expiration to use. Same thing with an iron condor and the butterfly and the credit spread. And then from beyond that, I started making videos more specific to trading strategies, like applying a condor for the expected move Friday expiration trades, or applying an iron condor for an earnings trade. And then there are the volatility trades, the risk twist spread, or the VVS, the VIX volatility spread. Those videos that I created don't just explain what that strategy is or what the trade is. It actually goes into detail and helps you build the trade, tells you what deltas and why we want those deltas, and what the combination of those Greeks will be, and what your target profit should be, and why that is your target profit. Everything you need, even if you don't quite understand all of the Greeks of the options, are going to be in that video. All right, so how to leg into an iron condor, and why would we do that? So a cheaper product, right? Like Bank of America or AMD, sideways action all the time. And yet, if you wanted to build an iron condor on that, you really just don't get the bang for the buck, right? The squeeze ain't worth the juice because it's too small of a product. But if you leg into that iron condor, you can collect a lot of premium and keep your risk minimized. So it's a win-win, right? That's just one of the videos in here. We got the duration iron condors, Greek neutral debit spreads, how to build your debit spreads in a way where the theta decay isn't bothering you, and the time and the implied volatility doesn't affect you too greatly, right? And then we talked about the rolling credit spreads and how to measure your profit between different options trades. There was a running dispute last year about different ways to day trade options and how far in the money you should go and what delta you should use and what expiration. And what it eventually happened is we needed to have a definitive answer. Who's right? Well, it turns out that there isn't a right or a wrong. There's what fits your risk. If you build your spreads in the money, do you have a better chance of success, and will you make more money if you and as opposed to building them out of the money, or as opposed to building them at the money? What if you use Friday's expiration versus the 30-day expiration? How could you compare all 6 of those trades and figure out which one is right for you? It would be in that video, right? That content is what I spent most of the early part of 2019 developing. It's back in vogue. Yesterday in the day trade chat room, people wanted to look at earnings plays for Costco, or not Costco, QCOM Square, and Roku. And they wanted lottery plays. But if you go in and you look at Roku, for an example, and look at those options, they're too expensive to put a lottery trade on, right? You don't want to put on a $400 lottery trade. Remember, a lottery trade is pretty much where you're it's all or nothing. You're swinging in the wind, and you're either going to completely hit it out of the ballpark or you're going to miss, right? So these options, they're just way too expensive to just grab a call or grab a put and run it into the trade. Same thing with these aren't as bad, but Square wasn't much better. And look at the price of these puts. Now we are, still 8 minutes to the bell. These values are not accurate. They're not real. But these numbers don't work for uh, lottery tickets. And then there's the idea of the vol crush, where we started the conversation. We know for a fact, without a doubt, that this is going to get crushed in volatility. So grabbing a naked call or grabbing a naked put means you not only have to be directionally right, you have to be directionally right enough to be able to beat the volatility crush. So what try to encourage people to do is don't just build an options trade. Build an options trade that takes advantage of the direction of the implied volatility. If you know for a fact the volatility is going to go down very quickly in the next 5 days or 2 days or 1 day, then build a trade that makes money when volatility goes down. You can also pick direction if you want to, and even if you're wrong directionally, you might not have as bad of a losing trade, and you could even break even just from the idea that you were able to recoup some of the losses because of the move in the implied volatility. Right? So one of the trades that I like to put on for earnings is an iron condor trade. You put a credit spread above the market, you put a credit spread below the market, and all the market needs to do is stay inside that range. If the market explodes to the upside and challenges the top of your credit spread, you take that one off. You take that one off and you leave the bottom one on. You still have premium in the trade. If you get challenged to the bottom side, you do the same thing. You take the bottom one off and you leave the top one on. More often than not, an earnings play will get very volatile after the bell. It'll whip all over the place, and then in the next day's trading session, it will average back out again, right? Or within a week, it will average back out again. And that's not always the case. There are plenty of examples where a market had earnings and it went to the moon and it never came back down again, right? But the the iron condor makes money in a vol crush. You can hit your target quicker from nothing more than vol crush. And remember, you don't need price to move in the iron condor. You just need price to not hit your strikes, your anchors. Good morning, Lorraine and Big Bear. Anybody else I missed? Good morning, good morning. So, uh, this is the kind of stuff that we need to be talking about. And I wanted to kind of refresh a little bit, maybe hit up a couple of the probabilities. Um, when I started trading options, I had a small account. And one thing that pushed me towards options was that I needed leverage. Good morning, Gordon. I needed leverage. Don't let the fancy financial speak throw you off. I had a small account. I had $300 to $500, and if I wanted to trade shares, I couldn't get very many shares, and more often than not, it had to be a really cheap stock. So I needed a way to trade more expensive products because they have a better chart, they had better uh, technical analysis, but I couldn't afford to do that. The only way that I could do it was to use options. That gave me a way to control large share sizes without a lot of capital. That's leverage. May 6, 2019, they came out with the micro futures. And you get way more leverage with micro futures than you do with options. And there's no PDT. There's no time decay. There's no Greeks to deal with. The educational curve to trade micro futures is about the same as the educational curve to trade shares of a stock. So you can see the great possibilities there. You can trade leveraged with less risk than options with a small account, way smaller account than you could ever do with options. And you can trade 22 hours a day with no PDT. Every single thing that is negative about trading has been taken away with these new micro products. So yes, I started my career trading options because I needed a leveraged product and it was the only thing out there that I could do because I couldn't afford to trade regular futures products. But now with these new micros, that is the future of trading, especially with a small account. I see all the time these different places that want to do account trade challenges and all kinds of stuff like that, and they do like small account challenges. Hey, that's great. You can take $250 and put it into a trading account for futures, and within 1 year, you can be taking enough money out of the marketplace to be a stay-at-home trader. That's not a pipe dream bullshit. That's the reality of the situation. You can't find it, Gordon, because I still can't get YouTube to accept it, and I haven't had the time to figure out why. It thinks it's a duplicate, and it's not. And I don't. I tried to rename it. I tried to recode it. It still won't take it, and I I just haven't had the time to get it figured out. It's been a heck of a week. My school started back up this week, and it's graduate statistics, which is just enough to blow your freaking mind. And add to that we're going into Black Friday at work, so it's overtime and extra training, and it's just been a mess. There goes the bell. Looks like my computer clock is 2 minutes slow. So no, you haven't missed it, Gordon. I did talk a little bit about the micro futures last week, and the only thing you're missing is the idea that I'm trying to get people to realize that with a micro product, you grab one contract at a quarter and you hang on to it to the next quarter. You don't need a strategy video to tell you what that looks like. When you go from the major levels, just look at this on a 30-minute, a 1 hour time frame. Look at what price does when it hits these levels. Where did it come from? Where are we going? Where did it come from? Where are we going? Again and again and again. You risk around $10 with a profit target of $25. Your win rate is better than 80%. So the disparity in there between risking 10 to make 25, it's more than enough. And you put on the trade and let it go. So you're not missing anything. What you won't find in my videos is some very detailed, exacting strategy that's going to let you know which way direction's going. Because guess what? Nobody goddamn knows where direction's going. Nobody. I know that all those trading firms out there want to imply that they actually got some idea of where direction's going, but nobody knows where it's going. Steve, the main brokers that run a nightly sweep like Interactive, Tastyworks, Thinkorswim, they're going to run this margin that's a very expensive margin. That doesn't work for me, and it doesn't work for a lot of small account traders. So there are other companies like NinjaTrader and Tradeovate who have a set figure. These margin values are calculated based on a risk-reward ratio formula given to them by the marketplace. And I call it like a no shit formula. What's the absolute worst that could happen with one contract in a daytime period? And that formula gives them this initial margin value. But not every company uses that. Some of them, like Tradeovate and NinjaTrader, have a set rate fee. So a micro is $50, and a mini, like the S&P 500 mini, would be a $500 contract flat rate. Don't matter if you get, as many as you want. You want 5 of them, it's 5 times 500, whatever. So we trade with that. NinjaTrader has a $400 account minimum, and Tradeovate has a $250 account minimum. So you can choose which one you want to use, and if you want to If you want a mobile device, I would say, probably want to go with Trade-Evate. If you're going to be a desktop jockey, then probably NinjaTrader might be a little better for you. They both have their positives, they both have their negatives, but both of them use the same value to calculate their margin. And it's 50 for micros, 500 for minis. You can't go wrong. Yep. So those are great tools. Those micros are a way for you to grow a small account large enough to be able to trade options. I'm not stepping away from options, but look at the market that we've been in for the last 3 to 4 years. The whips and the chaos are not diminishing, they're increasing. Nobody can identify market direction, and even if all the technicals get it right, one tweet will twist the market around and dump it right on its head. There is no way to get your win rate from direction greater than 65% consistently in this marketplace. There isn't. Now you can go out and you can find products that are running sideways and start putting trades on that don't need price moves. And then you can take your win rate up into the 80s. No problem. The issue with that is money. Money is what you need to be able to adjust and hedge options trades. And if you're running in a small account, you can get a trade on, but then you don't have enough money after that to do anything with it. Right? And if it starts to go against you, your only option is to get out of the trade with a loss, stay in it, hope it comes back around. And those aren't really great options. You'd like to have something better than that. So when it comes to options trades, if you're dealing with a small account, you're going to have to start focusing on things other than direction. If you need to increase your win rate, there are a few things that we can do to increase your win rate. Move your target. Instead of going for 50%, 90%, 150%, start aiming for a profit target like the rest of the what they call smart money does. I hate that term. Smart money is bullshit. It's not smart money. They just have enough money to hedge their losers, and we don't. All right. So I hate the word, but I don't know any other word for it. The biggest trading firms out there brag about making 11% year over year over year over year. The biggest names in the business. That's literally their target model, 8 to 12% or 8 to 15%, and they tend to average at about 11 total. 11%. Can you imagine that? That sounds like shit, right? Who wants to risk $100 to make $9? That doesn't sound very good, right? But change the language around a little bit. Would you risk $1 to make 5? Probably, right? That sounds good. I'll risk $1 to make 5. Well, what if I tell you you only have a 30% chance of winning? You still willing to risk that $1? Maybe. So what about risking $5 to make 1? The NQ just tapped that 50 and took a rejection. That should have been anticipated. That's the first test since the open of the 50. You should have had a sell order there to go short. You could have already gotten risk out with 5 points. That's all it would have owed you, by the way. That was a soft rejection, and here it goes for another break. Look at the strength in that move. There's your entry to go long, and 62 should be your full exit on that. That puts you right at the left. If you look left at the price shelf where it tagged 62 earlier in the market. All right, so would you risk 5 to make 1? That doesn't sound very good. What if I tell you you have an 85% chance of winning? Now the numbers start to sound a little bit better, right? You could risk 1 to make 5 with a 20% chance. That'll pretty much take you to even. Or you can risk 5 to make 1 with an 80% chance. That's greater than even. All right. If you do these trades day in and day out all year long, by the end of the year, the one that's making 80% wins is the one that's going to get you across the finish line. So how do you get that 80% win? You got to run your probabilities and you got to close the trade early. I'm not the only person in the world who's ever mentioned this. Tastyworks has done a ton of back testing on how to increase your win rate. And one of the things that they focused on was closing the trade early. That's why Tastyworks never charges you to close a trade. Even before everybody jumped on the bandwagon to go free trades, Tastyworks was already promoting the idea that, look, we want you to manage your trades. That's how you increase your win rate, getting profit out of the trade. So we don't want to charge you for it. They were encouraging people to manage their trade. The other thing that you can do to increase your win rate is to widen the width of your spreads. There's a problem with that, though. If you're a small account trader, you can't go very wide, right? It's too much buying power, and then it takes the trade way beyond any type of appropriate risk. There's a lot of places out there that talk about not using more than 2% or 5% of your account, but let's be realistic. If you have a $500 account, even using 5% of that account, it's not going to be enough to get you into a decent trade, right? So those kind of numbers just don't work for a small account. So what do they consider a small account? I've listened to a lot of the biggest names out there, Tastyworks, Options Alpha, a couple of others, and they consider a small account in options $5,000 to $10,000. I started with $300. So what I consider a small account compared to what they consider a small account is two completely different things. And they're saying that with a $10,000 account, you're just barely running enough capital to be consistently profitable. Now, maybe they have unrealistic expectations, or maybe they haven't just crunched the numbers. I don't know. I don't know why they think that you can't do it with less than that or that it's too hazardous. But the main thing that they focus on is not allocating too much money in one single trade. And that is true with a small account. You're going to break that rule again and again and again. Right? You have to, or you won't be able to get into any trades. So let's take a look at some trades that we can do with volatility, and just from something as simple as volatility. We're not even going to deal with direction yet. First, let's just find some products to trade. So last year, when I was still learning about options and learning about trading, I paid for the Options Alpha watch list. It's a one-time fee. It's $50, and I was trying to get my cousin into trading, so I figured, in the end, it wouldn't be a waste, right? Because I'd be able to pass it on to him, and then maybe he could pass it on to his children, and, the gift that just keeps giving. He bailed on trading, and I outgrew the need for it, but it really is a handy tool to very quickly screen for products that are tradable due to their implied volatility. So I'm going to fire up Options Alpha. And by the way, when it comes to free content, this guy has taken free to a whole new level. He's got these guides and checklists on all kinds of stuff. I've been listening to his podcasts while I'm at work, and there are a few things that I disagree with Kirk on. Kirk is the man that owns and runs Options Alpha. Him and I don't always see eye to eye on everything, but he's got like a 7-point checklist that you would want to look at before entering a trade. He's got an earnings PDF document that'll kind of explain how to build an iron condor, which I talked about yesterday in the swing trade in the day trade room. The circus maneuvers that he has you go through to figure out the width of your iron condor, it's crazy. You don't need to go through all that stuff. There's a very simple, low-tech way of doing that. But he has this watch list that's very easy to figure out what you want to do. You choose if you want high or low implied volatility. You choose if you want earnings trades or not, and then how you want them listed. Do you want to go high IV, low IV, and then you get the list. These purple megaphones up here in the upper right corner lets you know that there's an earnings event. And the earnings event is why most of these have a high implied volatility, but not all of them. HP is getting bought out, or there was an offer to buy them out, or something. There was some news yesterday on that. And if you go look at the H&P chart, you would see the drastic moves in the marketplace, which caused that volatility to ramp up to 100. But for a lot of these other ones, it really is just because of the earnings. And you got to realize that's a second tier Greek. That implied volatility isn't real. And I've proven that time and time again. When implied volatility expands, so does your expected move. But before an earnings event, if you go in and you look week to week to week at the expected move average here, when you're going into an earnings event, you'll notice that it actually compresses while the implied volatility is expanding. One of the products I typically do that demonstration on is Google. If you go to Google and you go to the way back, which for us would be February, which is when they had earnings in February of 2019. There's the think back. Set it to Google. And we want to set the date. We'll start in January. January 2019. And what we want to look at is what the implied volatility was in January before the earnings event. And then we'll jump week through week, getting closer and closer to the actual date of earnings, and we'll look at what the implied volatility suggested for the expected move. Laggy booger. Come on, Thinkorswim. You can do it. There you go. So I did get my trading account for Tradeovate. I did get that approved last week. Been so hectic, haven't even been able to do anything with it. But since I'm waiting on TradingView to have their Black Friday sales event, I'm not missing out on anything yet anyways. Their Black Friday sales event takes 60% off of the yearly subscription for TradingView. So I'm really interested in getting that done. But I just found out Tradeovate has custom indicators. So I might not need TradingView after all, which is really good. It just saves me a little more money out of pocket. All right, so here's the options for January 2019. And you can see that we want the February 8 earnings. And notice how these two change between 30. It shouldn't go down and then back up again. This 31 and 30 right here, this lets you know where earnings is at. It's right in here, right? And we could jump out to the chart and get that date specific for Google. I know it was in February, second week, I believe, but we can go and check. So here's February, January 30. So pretty close. So January 30, we need the last week in January, first week in February. February 1 would be the options we want to play with. The implied volatility was 21.8. It's a $38 expected move to the upside or the downside. Let's jump forward in time 2 weeks. Remember this value. $38 expected move. 21 implied volatility. 21.38. So here we are with that same. Now I went too far. Let's go back one day. Midweek, the 30th. Now we're at a 32 implied volatility and a $22 expected move. The implied volatility expanded, the expected move shrank. That's not the way it's supposed to work. That demonstrates to you that that's a second tiered Greek. Okay, the Greeks aren't real there. The implied volatility is not real. That doesn't mean that it doesn't affect the options value. It's just to show you that if you're going to run a credit spread or any kind of premium trade, that implied volatility is not real. It doesn't change the value of the option the way regular implied volatility would overly inflate the value of an option, right? All they're doing with this is shunting the theta decay so that they can keep the expected move as balanced and neutral as possible so that they can use their forward guidance. And that's it. Right? And then right after the earnings event, they don't need to compress that theta decay anymore. They let it all go. The theta gets recalculated and the volatility dumps like a rock. So that's how you can go back and re-demonstrate that to others if you need to explain it to them. So now that we know that the implied volatility isn't real, we can use that when we're building our trades to understand that we can take advantage of it. Because like I said, we know for a fact it's going to get vol crushed. And you can't calculate 100% how much you're going to lose, but you can get a really good ballpark if each earnings loses at least 10 points of volatility. Then you start to get an idea of what to anticipate at the next earnings when it's getting close to that time, on what to expect, what's it going to do, right? So back to the options alpha list. We've got a list of products here. Disney is something I hear about day in and day out, and whenever I run the Discord command for what is popular at the moment, Disney is on that list a lot. So let's go take a look at Disney. It's got an implied volatility rank of 77. So it's in the 77th percentile. One of the reasons that I got the options alpha watch list is because when I was new to Thinkorswim, I couldn't find rank. Drove me crazy. Thinkorswim doesn't have rank. What it does have is implied volatility percentile. And that's rank. It's the same thing. It's just the word rank isn't there. So Kirk shows Disney at a 72. Thinkorswim shows Disney at a 52. It's got an implied volatility of 27. It's in the 52nd percentile. One great way to just get the language right on this is within the last year, Disney has been at a 27% implied volatility 52% of the time or less. It's been either 27% implied volatility or less 52% of the year. So we're almost right in the middle. 52 is nothing. If it was 20, then we could anticipate a rise in implied volatility. If it was in the 70s, we could anticipate a fade in volatility. But when it's sitting at 52, it's sitting right in the middle. We can't anticipate which direction the implied volatility is going to go, except there's earnings. At the end of the day, today, there's earnings. So we know now which direction the implied volatility is going to go in Disney. It's going to go down. How much? If you look left, 0.2 looks to be a good ballpark place. So if we're at 27 now, we can anticipate a 7-point vol drop. So how can we use this to our advantage? We can build an options trade that takes advantage of this implied volatility crush at the same time that it takes advantage of a price move. Literally, there is no anticipating which way the market is going to go. There is none. We can choose to stay neutral or we can pick a direction. Look at the theta in the Disney puts. And in case you didn't know it, yes, theta can go up and it can go down. Theta is not linear. It doesn't just go down. It also goes up. And this is a really great example of that. A lot of places try to imply to you that theta only goes in one direction, but that is absolutely not true. Mel, if I was to put a trade on due to what an indicator told me, I might as well just quit trading. There is no way I'm ever going to pull the trigger because an indicator suggests to me that a product is worth trading right now. Now, I could scan for products looking for something that has an oversold RSI, and I could scan for something with that connected to IV. But I certainly wouldn't want to run out and put a trade on just because the RSI says it's oversold. That'd be a horrible idea. So let's run with that, Mel. Let's run with that. What IV would you use? Would you use a high IV or would you use a low IV? Okay, well this is a good day for you then if you're new to IV because to trade options successfully, the key is IV. Implied volatility changes the value of that option greater than any other Greek out there, especially in something like leaps or things that are going to get vol crushed. That's why the risk twist spread, which I posted a trade for yesterday, is such a wonderful trade. So here's how IV typically works. When a product goes up, the implied volatility goes down. And if you think about it, it makes perfect sense. So when a product has low implied volatility, the only thing that we could expect volatility to do is go up because it's really low. It won't bottom out. You know what I mean? It won't ever go to zero because there's always going to be some volatility. Options get their pricing from volatility, so we know they'll never not have volatility. So when it's really low, we can put trades on to buy volatility because it has nowhere to go but up. When it's really high, we can sell implied volatility because it has nowhere to go but down. Now, it can stay down and it can stay up, but it doesn't. More often than not, and if you hunt for the products that move, more often than not, the implied volatility shifts and changes as price changes. So if it is high, we anticipate it to go low and then we sell it. And if it's low, we anticipate it to go up and we buy it. If you can pair that with price in a directional move, you're a pimp. But we already discussed the fact that nobody can get direction right. And that used to frustrate me Because if you watch social media, there's a lot of people getting direction right. But they're not telling you how many times they lose. They're just showing you the ones they win. Direction on a swing trade, and we are talking swing trades here, not day trades. We can day trade direction because we got momentum, we got trend, we got, you know, inertia. But when it comes to a swing trade, there's too many variables. There's the overnight hours, and then there's the random tweets and Yahweh and tariffs and Brexit and presidential impeachment and all these other things that move the market around that have absolutely nothing to do with technical analysis. So direction is shit. What we do is we can trade implied volatility without price direction. We want to be like a delta neutral. That way, we make money when the implied volatility expands or contracts, and we just need price to not do something. And that's a hell of a lot easier to do. When we go back and we look at charts, we can identify price ranges really easy. The newest traders out there can see a range. So all you got to do is ask the question, where is price not going to go between now and expiration? And yeah, you can get this wrong, but I guarantee you, you won't be wrong as often in this as you are trying to pick direction. The problem with picking direction isn't just the idea that we think it's going to go up, but with options, when is it going to go up? If it goes up too soon, we don't make money. If it goes up too late, we don't make money. If it doesn't go as far as we thought it would, even if it does go in the right direction, but it doesn't go far enough, we don't make money. See, all of those problems for direction is why people lose options trades again and again and again and again. Too many variables. You can get the direction right, but maybe your target was too far away. You can get the direction right, but maybe it didn't move there fast enough, or it got there too fast. So all of that, we want to just throw it away and instead focus on what we can focus on, which is if I don't want or where I think price won't go. So if we're looking at Disney and it validated this new range after it gapped up way back here and everybody was crying that they missed it. Well, they didn't. They didn't miss anything. It validated this range and this has been its new reality. We got earnings coming up and there's one of two things that are going to happen. It's going to explode to the upside, break this range and build a new range up here, or it's going to come back down into this old range, A or B, one or the other, right? So we've narrowed that down. The implied volatility says this can only move so far. So even though it seems like it's an A or B, we can actually do C. It says that Disney can move. Come on, Thinkorswim, freaking slacker. Disney must be a union worker. It only works when it wants to. It takes a lot of breaks. So it's giving us a $4.50 expected move from the market makers, but it's giving us a $5 expected move by the end of the week. We could use just that $5. And we could say, all right, look, it's at 132. We could put on an iron condor below 128. That's our $5. We can even take it a little farther than that. And me, since I'm risk averse, I want to go a little farther than that. So instead of just a $5 move, let's give it a $7 move. Let's say from 32 to 25. This doesn't seem like very much money. I've got a $1 wide trade. They're offering me $11 for it. That's shit. All right, that you can't pay the bills with that. But my probability of being right is 91%. 91%. Would I risk $1? Would I risk $9 to make $1? If I have a 90% chance of being right? Sure I would. So since we went from 32 to 26, we need to go from 33 to 39. Does that sound right? that sounds right. Need a couple more strikes. Now remember, this is a really wide trade. We don't have to go this wide. But since I'm risk averse, I'm more comfortable going this wide than I am hugging price. For each person, they can decide for themselves how much aggressive they want to be. So here we're looking at a profit of $34 and a risk of $66. We're not even close to a 50-50, but we're better than that 9 to 1, right? We're better than that now. If we kind of round this a little bit to 35.65, it's not too bad because our probability of being right is so high, right? As long as Disney stays within this range, we make profit. If volatility, and it's not a if, it's when volatility gets crushed, this green line is going to spike up towards the top of this. So if we wanted to exit the trade early, say with a 50% profit, we could have our sell order in, and when the volatility spikes, it can get us out of the trade, not waiting for time to go by, because time is what will move this green line up to here. If I start walking through the days, come on. My goodness, what a lagging booger. All right, let me pause the stream for a moment. All right, so for everybody here on YouTube, swing by the Bullish Bears website. You can join for the 14-day trial and get more familiar with the material that we've developed for options trades. You can also sign up to become a member and get our live trade alerts. I look forward to seeing you there.